Okay, everybody. So if you clicked on this video, okay, if you clicked on this episode and you listened to it and you got to this point, this is the reason why you probably clicked on it, okay? This is the way that I feel that you should be utilizing the stock market as a savings account. Instead of actually having a savings account, I believe that this ETF is the one that you should be purchasing, and you should be housing your savings in a brokerage account, not a savings account, in a brokerage account. And this is the Schwab US Dividend Equity ETF, ticker symbol SCHD, and the expense ratio is 0.06%. That is a very, very low expense ratio. Okay, let's put this expense ratio into perspective. Let's say you have a 401k. 90% of people that have 401ks, and I really want you to do this, I want you to go look at your 401k if you have one. I want you to see what you are investing in. I bet you that you are invested into a target date fund. I know that you are invested into a target date fund if there is a date beside the fund's name. I guarantee you that the expense ratio that you have on that particular fund is probably higher than this expense ratio. So this is very, very low when we're talking about the entire industry. This is what I like. Now, let's talk about what is this ETF and why I believe it could be utilized as a pretty good savings account. What's the objective? The fund's goal is to track as closely as possible before fees and expenses the total return of the Dow Jones US 100 index, right? It's a straightforward, low-cost fund offering potential tax efficiency, right? The tax efficiency is very, very important because the dividends that you collect and the dividends that you reinvest, once they become long-term capital gains, you'll be getting them at a better tax rate than you will be from a regular old savings account. Number two, the fund can serve as part of the core or complement a diversified portfolio. I believe in a diversified portfolio. I believe you should own Tesla. I believe you should own AMD. I believe you should own Apple, right? I believe you should own Pepsi. I believe you should own Procter and Gamble. I believe you should own Waste Management. I believe in a diversified portfolio. And this particular ETF is a good way for you to have a diversified portfolio. Number three, it tracks an index focused on the quality and the sustainability of dividends. We're going to go through the holdings in this particular ETF, and you're going to see what I'm talking about when I'm talking about quality. This ETF is all about quality, right? It may not get the best returns, even though it gives some pretty good returns, and you're going to be surprised the returns that you see. But I'm telling you, this ETF has the quality that you're going to need when you're talking about investing into the stock market. And number four, it invests in stocks that are selected for fundamental strength relative to their peers based on financial ratios. When I talked about how do you pick good stocks, okay, how do you pick good stocks episode, I talked about picking stocks that are the best in their industry. This ETF houses stocks that are the best in their industry. I promise you on that. Now, let's take a look at the returns for this particular ETF. Now, this particular ETF started on October 20th, 2011. So it has some time. And I believe that it's withstood the test of time because it's been around over 10 years. So I believe that it's withstood the test of time. I want us to focus on the top price. Okay. I want us to focus on the market price. Don't worry about all of these prices down here at the bottom. Just worry about the prices at the top row. Now, let's look at what it's done so far this year. Now, we know the stock market had a very good start to the year. So year to date, at the time of this episode, this ETF is up 2.08%, which is very, very good, right? It's very, very good and something that you should understand. Now, let's look at the annualized returns. Okay, what has the stock been doing over the course of time? Over the last year, this stock is up 1.56%. Okay, that's very, very good. And even though we've been through the year that we've been through in 2022, like let's just put 2022 into perspective, because I really want to put this into perspective for a second here. 2022, from a historical perspective, was literally one of the worst years that we had in the market, right? We're talking about 2022 had the worst year of the 60-40 portfolio going back to 1936. The worst year since 1936, right? How long ago was that? How long ago was that? Like, put that into perspective. We went through one of the worst years in the history of the stock market, but over the last 1 year period, this particular stock is still up 1.56%. So what this tells me is that even though it goes through the depths and the valleys of everything that's going on, this particular stock is going to be able to hold its value. So if you want to be able to have this money in a savings, so if you want to utilize this as a savings account, which I believe is a good idea, think about it from this perspective. This stock was able to hold its value during one of the worst years in history. That should make you feel good about holding this particular stock. Over the last 3 years, it's up 14.54%. Over the last 5 years, it's up 11.16%. Over the last 10 years, it's up 13.35%. So this particular stock has been giving you very, very solid returns. Now, very quickly, let's do a comparison to the S&P 500. Year to date, the S&P 500 is up 6.28%. Okay, so it's up way more than what this particular ETF is, but that's fine. But over the last year, the S&P 500 is down 8.22%. So it's down much significantly. So let's say, for example, let's say you were using the S&P 500, for example, as a savings account. Over the last year, you will be down 8.22%. But with the Schwab ETF, you will be up, right? Over the last three years, 9.88%. Schwab did better. 9.54% over the last 5 years. Schwab did better. Over the last 10 years, 12.68%. Schwab did better. Schwab did better in all of these particular aspects. So I really want you to put all this into perspective. The S&P 500 is a great place for you to be. This is not to poo-poo on the S&P 500, but this is what I want you to understand. This Schwab ETF is all about quality, right? It's about dividends, right? It provides a very, very solid dividend. We're talking about over 3% from a dividend yield perspective, which is great, right? It's great when you think about it. And so when you put this into perspective, I believe that this Schwab US dividend ETF is a very, very good asset to your portfolio. The money that is sitting in your emergency fund, that's just sitting there, that's just growing, it should be doing something. I understand that it's there for emergencies, and I understand that it's only there for a rainy day and things of that nature. But again, I'm gonna continue to keep harping on this. That money has got to be working harder for you than you are working for it. And I want you to get all you can get from your money. And okay, so I'm about to show you all a chart of how the performance has been for this particular ETF. And this is going to show us the cumulative growth of a $10,000 investment. Now, this particular chart right here is just for illustration purposes only. Okay, this is not to sit up here and tell you that you're going to be able to get this same investment or whatnot. Now, I want to tell you this. I know that I've talked a lot about how I don't like savings accounts in this episode, but at the same time, I'm not going to give you an incomplete picture. I'm going to make sure that you have a complete picture and you have all the information so you can make sure that you are able to make a decision for yourself. But I'm telling you right now that, you know, I like this chart. And the reason why I like this chart is because it's continually moving up and to the right, and we're continuing to add value. Now, I also want to provide more context, okay, when we're looking at this particular picture. 2013 to 2023 is arguably, and if we look at the statistics, it may be one of the best. It may be one of the best subset, like one of the best 10-year performances that the stock market has ever had. I know that we had some great performances in the 90s. I know we had some great performances in the 80s. I think we had some decent performances in the 50s and whatnot. But this may be one of the best runs that the S&P 500 has ever been on. So I also want to put that into perspective as well. But this is what I want you to look at. Like I said, focus on the blue line. up and to the right. Your money is going to be continuously growing when it's in this particular ETF, right? It's going to be continuously growing in this particular ETF. You're going to have times to where it comes down and the value of the ETF drops, like it is down here in 2018. But the value came right back up in less than a year. Dropping down, value continuing to come back up in less than a year. The worst return period that we had in 2020, the value came down, but the return came back up in less than a year. Think about what we were doing in 2022. We were at all-time highs in 2022. The market was in full, jubilation, was in full euphoria, all-time high. We came down and we had a horrible drop in September and October. The market lows, they were bad, but guess what? We came back up and now we're pretty much back at an all-time high from this particular ETF perspective. I'm not even talking about from the S&P 500 perspective. We're talking about this particular ETF. This is what makes this particular ETF so freaking special, because we're talking about, look at that drop. This was a mean drop. 35,000 to below 30,000. That is not anything to play with. That is nothing to play with. But guess what? We're back to all-time highs on this particular ETF and this particular investment. So I'm telling you, you're going to deal with the valleys, you're going to deal with the lows, but you're also going to be able to get your returns back. I promise you, if you just continue to be patient. Okay, now, like I said, down here, I want us to focus on this very quickly here, because I want to give you a complete I want to give you a complete perspective here. I want to give you a complete picture here. The worst 3 months returns that we had was from December 2019 to March 31st, 2020. The ETF dropped 21.5%. It wasn't good. But the best 3 months return that we had was from January 2021 to April 2021, an 18+% return. But this is what I want to tell you though. Let's also continue to put that into perspective as well. Remember, we're talking about a 10-year time horizon here. 10-year body of work. This is a body of work. And when you look at something over a 10-year period, we're talking about looking at what has withstood the test of time. Okay. The worst 3-month period that we had was in 2019 to 2020. The best 3-month period that we had was in 2021. So the worst and the best returns that we had was within the last 3 to 4 years, right? So what that tells us is that the market has been very volatile over the last 3 to 4 years. But at the same time, though, is still being able to do, the ETF is still being able to do what it is designed to do. So you have to give it the time, right? You have to give it the time, right? This is not an ETF that is going to make you rich overnight, right? It's not going to make you get rich quick. But again, like I said, I think that this ETF is a good opportunity for us to utilize this as a savings account. And I'm going to go over the holdings of this ETF. And I want you to look at the holdings of this ETF. And that's going to provide even more perspective in terms of why I believe that this is a good ETF to have as a savings account. Okay, everybody. So these are the top 10 holdings in this particular ETF. Now, I'm going to run through these companies very quickly. Broadcom, Verizon, Cisco Systems, Texas Instruments, Home Depot, Merck & Company, Lockheed Martin, PepsiCo, BlackRock, and Coca-Cola. Now, I'm going to tell you, you should feel very, very good about these holdings in this particular ETF. And there's 3 reasons why I want you to feel good about these. Number 1, now let's put this into perspective, okay? There's a mix of dividend growth companies they're continuing to grow their dividends year over year. There are dividend aristocrats and there are dividend kings. So, for example, let's talk about a company like Home Depot. Home Depot is a dividend aristocrat. Okay, what is a dividend aristocrat? A dividend aristocrat is a company that has paid a dividend and grown the dividend for 25 straight years or more. Home Depot has done that, right? That is something that we need to understand. And this is why this is important. Understand that they have been continuing to pay the dividend and grow the dividend for 25 years. So what does that mean? Number one, that means they never cut the dividend. That means through every economic environment, through COVID 2020, through the global financial crisis, the worst crisis since the Great Depression, through the dot-com bubble, right? They were continuing to pay the dividend. Okay, Home Depot, dividend aristocrat. That makes me feel very, very good. Okay, that goes back to the quality piece that I was speaking about before. This ETF has straight quality. Coca-Cola, right? One of Warren Buffett's most favorite companies, right? What is Coca-Cola? Coca-Cola is a dividend king. What is a dividend king? A dividend king is a company that has paid a dividend for 50 years and increased the dividend for 50 years. Okay? Coca-Cola for over 50 years has been paying a dividend. So now we have to put this into total perspective, right? Over 50 years. We're talking about global financial crisis. We're talking about COVID. We're talking about dot-com bubble. We're talking about Black Monday. We're talking about the worst inflation period that we had in the 80s. We're talking about recession that we had in the 70s. We're talking about Coca-Cola has been paying a dividend through all of that. That's the type of quality that we're talking about in this particular ETF. That's why I feel good about having it. Number two, this is the thing. You're only going to have quality you're only going to have quality companies in this particular ETF. But this is the thing. In a worst case scenario, y'all, in a worst case scenario, all of these companies right here are not going to cut their dividends all at the same time. I would argue with you. I have not done the research on every single company, but I would argue with you that there is probably not one company in here that has ever cut their dividend. That makes me feel even better because I am associated with quality. I'm investing my money in quality. I understand that I am being fixated and I am being inserted and I am being associated with quality. So my money is going to be where it needs to be. It may not be up all the time, but I'm telling you, if you keep that money here for a long period of time and continue to add to it, it's definitely going to serve to you as a very, very quality savings account. And number three, I don't have to be a stock picker and I don't have to be the best dividend stock picker. Guess what? I'm getting at least a 3% dividend from this particular ETF. All of these particular stocks, they all pay out varying levels of dividends, right? If there's a stock that pays out a 4.5% dividend that I may really want, right? If I choose to buy that particular stock, guess what? I get to take on the risk of that particular stock. And that particular stock, what might it do? That particular stock, it might go bankrupt. It's a possibility, right? This particular stock, it may slide off from the dividend growth category. It may not be growing its dividend as much. It may slide off from the dividend aristocrat category. It may stop paying its dividend after the 26th or the 27th year. It may slide off as a dividend king. It might stop paying dividends after the 50th year or the 52nd year or the 75th year, right? But if I have an ETF that has a collection of dividend companies, I don't have to worry about one particular dividend company folding on me, because I have a whole host of dividend companies that are on my side that I'm associated with that has the quality. And so it makes me feel good that I have dividend companies, quality dividend companies. And that's the thing. I really want you to understand, and this is a word that I want you to take away from this particular episode, quality. When you're investing into the stock market, you have to understand what is quality. If you're going to be investing into a singular ETF, you're going to have to understand what is quality. If you're gonna be able to invest into a high growth stock that is very, very volatile, you're going to have to be able to identify and be able to categorize quality. And so I'm telling you, this particular ETF can put you into a position to where you can make it to the next level.